Thank you everyone for your patience. They're incredibly busy doing deals outside, I think. I'm really hoping anyway. But people are coming in now. I just want to say thank you very much to Marine, the Bazelaire, who's the Regain Nature CEO, for moderating the session. She will tell you about the speakers, but I've already given them a brief, which is to change our way of thinking about nature. So that's the KPI I've set them. We can all do a little test afterwards about whether they've been successful. Thank you, Marine. Over to you.
Does the mic work? Doesn't seem so.
Maybe they need to...
The mic. Does the mic... Oh, no? Shall I...
Are we okay for audio at the back for the speakers?
Check if it is on something. The thing.
Well, they say that shouldn't...
It's green, no?
It's green.
Okay, strange.
Does it work? Does it work?
Not full.
Does it work?
Audio is not working, guys.
Hello?
No.
Shall I move on stage? Shall I move there?
Move there while I go check.
Okay.
Old school.
So good morning, everyone, and thank you for joining this nature investing panel. We have 45 minutes to do something actually quite ambitious, to move, which is to move from we've done it, it works, to actually how do we scale it up. Shall I go back? So, does that work?
Yeah, it's working.
Okay, great. So yes, we're going to move to the land from it works, we've done it, from what do we need to really do to scale it up. It's going to touch on frameworks, on real asset pipeline, on governance, and on bonds, always keeping sight of what matters to us today, what's in it for investors, for them to be able to actually buy, hold, explain, and scale. The timing matters. We're on good track to actually miss the global biodiversity framework shared ambition to halt and reverse nature loss by 2030. Sean reminded us that we already know that we missed the climate one, so well, big deal. Another one we missed. Well, actually, it does matter because what we're talking about is not like a missed business opportunity, it's an existential threat. So meaning investing in nature is an existential imperative. The fact is that the financing gap for nature is still at 700 billion a year, so that's quite sobering, but let's not be fatalist, let's be optimistic. What the UNEP-FI is also telling us is that we move from close to 1 billion a year of investment in nature to more than 10 billion in only 4 years. So we're far from the 13 trillion potential by 2030, but still, I mean, it's really scaling up, and it's absolutely what we need to do now. So I'm Marine de Bazelaire, as Sean said, and I'm leading Regain Nature. I spent 20 years at HSBC, where for the last 5 years, I initiated and led the nature-related strategy. At Regain Nature, I accompany corporates, coalitions, institutions, projects developer to actually embed nature into strategy, into investment risk committees, and in boards. So what I suggest now is that that's absolutely what we're going to do now, and we have 3 very complementary perspectives with Martin, CEO of Climate Asset Management, who brings the real assets perspective, where the projects are, where returns can come from, and what it takes to build investable opportunities on the ground. Jacopo Gadani from Barclays brings the banking and capital market lens, how nature becomes part of client engagement, governance, frameworks, and financing activities. And Chris Atkinson from Fidelity International brings the fixed income investor lens, what makes a nature, climate transition, or blue transition bond strategy credible, liquid, and investable. So we will follow a simple arc. First of all, what's the investment frontier? Then what do we need to scale it up? And then what's the architecture of trust? So let's begin with the investment frontier. And obviously, I'm going to turn to you, Martin, because you're the closest to the capital investment case. What's the investment case actually for nature today?
Yeah. No, thank you very much. Thank you very much for the invitation. So Martin Berg, I'm running a company called Climate Asset Management. We are a specialist asset manager focused on nature or natural capital. And we are now 6 years in business. And one of our shareholders is HSBC. And I think it was partially thanks to Marine that HSBC was actually picking up the topic 6 years ago when not many, in particular not many banks, but also not many managers said we want to only focus on natural capital. So what is the investment opportunity? Well, I think there are a few perspectives. One is, as Marine pointed out, nature is on the one hand side a standalone issue that we need to tackle, especially the biodiversity loss. On the other hand, also nature is very closely linked to climate. Roughly a quarter of all emissions are nature linked. So in a way, nature is on the one hand side part of the problem, but on the other hand, also a real opportunity to solve the climate problems. And I think this is where the investment opportunity comes in. So we talk to investors, I think the whole narrative has changed, because I think a few years back it was always like, what is this nature? How can you invest in nature? And it reminded me always, and Sean may probably relate to that when he started nearly 20 years ago, it was like, and wanted to have a climate bond initiative. We said, like, how can you invest in climate? And the investor says, it's impossible to invest in climate. You can't invest in climate. I think we came a long way on that side. I think you here in the room are very clear what the subsectors are, what you're doing it. And I think the same kind of applies to nature. I think the ultimate investment drivers are that on the one hand side, we will use more nature-related products also for regular production. So if you think about timber, for example, we're thinking a lot more about wood constructions, a lot more of different use cases than what used to be basically a paper and pulp business. It is now, we can integrate it into buildings. Of course, there's a renewable energy component to it. And then the other component of the investment opportunities is the agriculture side. That's obviously not new, but what we're seeing is now that we are running with the normal, or with quote-unquote normal practices. We're running basically out of opportunities to continue to produce food in a sustainable way. And this is really where the investment opportunity arises. If we're speaking to investors, it's not about addressing generally either the biodiversity or the climate problem. It is really, there's a long-term investment trend that we're running out of land in order to grow more trees, and we're running out of land to do agriculture in a sustainable way. And this is what we do as a firm. So we have various funds where we're working with institutional investors to exactly do that. Maybe one of the interesting things is that when investors think about their green investment portfolio, it's very heavily at the moment focused on renewable energy. And what we're trying to say to them is, so look, you're completely underinvested in nature. So usually if I had my slide deck here, I would show you like a wonderful guy, but like it's a 0.1% of the allocations of institutional investors is invested in nature. When you look at the investment opportunity on the other hand, it's almost a bit puzzling that is not captured more. And in particular, if you think about it, it is something that sits a bit outside some of the other investment spectrum. So it's an inflation-linked and completely uncorrelated asset that actually sits quite well in institutional portfolios. So maybe I stop here, and I'm sure we're getting a bit more into the detail where some of the issues are.
Thank you very much, Martin, to actually remind what we mean by investing in nature, what's, in a way, a definition, how the investor are actually addressing the 5 pressures on nature with different kind of opportunities. And we're going to move to the banking lands. And please, Jacopo, let us translate that into the machinery of a bank. Does nature move into that machinery? And think of client conversation, governance, engagement.
No, sure. I will start with Martin with a very good point that climate and nature are very interrelated. Just an example, recently we really spend a lot of time in our frameworks or the sort of strategy to integrate the two, especially in transition finance, which actually does a lot of crossover in terms of space. And also, as an example, in farming is a very good point. We launched like last year a farm transition finance product to farm in the UK. As Barclays, we bank roughly 20% of all farm in the UK, and really try to exactly promote from a sort of sustainability, but also from a nature and, say biodiversity future, because, there's a lot of like soil consideration in the market, and it's going very well as a product. And, we really have a lot of traction, and I think also the sort of customer that are seeing the benefit, it just is like a snowball effect. Of course, there's a pricing incentive to help them, and some government support or, third-party supplier support, but it's really working well. I think from a bank, we really look at the sort of risk metric, and, as an example, we actually launched last year in September, like an assessment based on the TNFD LEAP assessment. We actually assess over 250 mining clients and over 9,000 energy assets. Given our exposure and portfolio, we actually found out 5 key takeaways. So first of all, is always the sort of $1 million question on data. So data is still sketchy. However, there is good work, or at least a sort of like a starting point to start to work on it, especially thanks to the regulatory framework or the TNFD itself as a good starting point for disclosure. I think as we mentioned already before, the climate and nature, they're related. There's definitely material risk. Of course, this depends on the sector and geography. So of course, not everything is material. So you need to kind of pick and choose your battles, or depending on your own structure internally. And I think you need to basically have engagement on your side. Talk to client. I think most of the clients are not really seeing the big picture. I think as a banks, actually, we have the opposite view, because we look as a sort of framework or portfolio perspective. We can really try to help them, how to guide them, but also in terms of policy and engagement. So there's not only about client or corporate, but there's also the policy making, the overall sector, the regulatory sector. So there is always like an effort. I mean, considering that this is not typical carbon emission, it's very difficult to quantify or difficult to pick and choose. Definitely having a sort of direction of travel where you should focus on or prioritizing, definitely helpful. And just to complement very briefly, we also look at the sort of product framework as I mentioned before. We have a sustainable transition finance framework where nature actually became a very big part, and especially we start to actually align more clearly to the global biodiversity framework in terms of objective and activities. But also we have external position statement. For us, the forestry or the sort of protected area is very key. So we really do like a proper due diligence on this aspect. So we have a proper like assessment, and it's for us, that's what we say. We look at sort of risk side, but also, as Martin was mentioning, opportunity side. Definitely, we see more appetite. We see all sort of corporate and client, or even actually financial institution talking to us to say, can we do more? So definitely, there is the momentum.
Thank you very much, Jacopo. So you see, capital allocation, we have the financial institutions are really measuring and embedding nature into their overall machinery. I'm turning to you. Chris, what about the investors, the fixed income? Do they have interest in nature today?
Yeah, absolutely. Just for full disclosure, I manage our blue transition bond strategy, so I'm coming at this from more the sort of marine angle. There is plenty of interest in the growth and development of the blue market and the blue theme more broadly. I think the challenge for us, and obviously I come at this from a slightly different perspective to the two previous speakers. I manage a pooled fund, it's daily liquidity. I need to be able to liquidate those assets if we have significant outflows. Those instruments generally need to be of scale, of benchmark scale, so that we can trade in and out if we need to. And therefore, we require the issuers that we invest in to be, undertaking some fairly significant projects. And that's where I think the difficulty, and I think most people in the room will be aware that the blue space is growing, it is developing, it's coming along quite nicely, but it could and it should be much quicker than it is. And part of the issue is around that financeability and that investability of some of those projects. We've tackled that by developing a framework that allows us to invest, obviously, in use of proceeds bonds, bonds that allocate a significant portion of the use of proceeds towards blue projects. But also we allow companies whose revenues are aligned. We also allow companies who are transitioning. We demonstrate that through CDP, water ratings, for example, and then mesh that with our own ESG analysis. That allows us to have a diversified portfolio. And I think sometimes in forums like this, we spend a lot of time talking about credibility. And credibility, to be absolutely clear, credibility is super important, but so is investability. And if we don't have a diversified portfolio of assets that deliver a market return, no one's going to invest in us. Right? We're just not going to raise any assets. We're not going to be able to allocate any capital to the theme. So therefore, we have to pay good attention to diversified portfolio of good, solid credits delivering an attractive level of return. If we do that, and we have a framework that has been established and is independent of me, obviously because everybody suspects portfolio managers as being profit-driven and all that sort of stuff. We have an independent framework that sets out the names that I can invest in. Then I think that gives us some credibility.
Thank you, Chris. I mean, you already jumped into the part of how do we scale up that market, and just before handing up the microphone to the others, can you give us an idea of where the blue market stands now and what's the potential, and if you had any additional proposition to scale it up?
How long have we got? Okay. So look, I mean, the blue market, I mean, it's come from essentially nothing.
Yeah.
In the last 18 months, we've seen a lot more growth, and I think that's partly down to the publication of the Blue Bond Standards 2.0. It helps, but it's a necessary but not a sufficient criteria. And I think part of the reason why we launched the fund, while the market was still very new, was to demonstrate that there is demand, right? To be able to go to issuers and say, look, we've got a dedicated fund here that we want to put blue assets in. Can you give us some, please? And I think the biggest problem that we have is that I think investors didn't realize that there was this demand. So, to just give you a few examples, a number of the bonds that we have in the funds, they're labeled green, but actually, in some cases, 100% of the use of proceeds are blue. We've got some, we've got the Tideway Tunnel, for example, which was originally labelled green, now has been labelled blue. We have some green bonds issued by Icelandic banks, where 100% of the use of proceeds have been allocated to sustainable fisheries. The assets exist. We just need to demonstrate that the demand is there. And then the second thing that we need to address is just to encourage those issuers to come to market. And that's why I encourage frameworks. I want frameworks. I need something to sort of fall back on if my name ends up on the front page of the FT. But we also need to encourage those issuers, excuse me, to not be scared to come to the blue bond market, right? That they're going to be held up as blue washing or green washing. If they get something wrong, we should be prepared to invest across a spectrum of assets from dark blue to light blue or dark green to light green, because they will deliver different return profiles.
Thank you very much, Chris. And actually, that's a perfect segue to you, Martin. I mean, for investors to have confidence in investing into the blue market, you need to have a robust pipeline of projects, and coming back to a wider space. What does need to happen on the ground to have that scaling up of projects that are investable?
Yeah, I think there are two issues for the scaling up of the market. One is just when you compare to with the broad brush climate investment, then it's obviously much smaller market segment at the moment. So that's one. So how can we build that? And then the other one is also, and it reminds me of the early days on green bonds. There's also much less clarity what it actually is. What's interesting is that, like I said, you immediately that you see the interest on the blue bond side, and we see that as well. A lot of investors are really attracted to the blue side, and I can understand that. It's a very charismatic investment opportunity. We all know that oceans play a huge part, and we need to address and tackle these issues. But when you actually look from an investment opportunity basis, then forestry and agriculture are just much deeper, more traditional markets, and actually have a lot more opportunities on a lot more or a lot clearer defined business models that would allow also in the longer term bond finance. Generally speaking, I think the market is still more at like what we do on the real asset side. So I think we need a lot more product in the market in order to actually have proper bond financing. And then the other issue is when for example, we're doing agriculture and forestry project where we also go out in the debt market and we raise debt. But we're actually only raising probably 30 to 40% max debt on a project, whereas in a renewable energy project, you probably go to 80, 85%. So there's some fundamental differences, but it's also probably the way we are financing the underlying. And I think we need a lot more, basically a lot more product in order to then also have the right bonds. So I think that's part of the issue. But I think it's growing. I think investors are becoming much more comfortable with it. And I think perhaps it's in the same way it took time for the climate side to actually mature and to have much clearer buckets and pockets where they sit. I think we will get there on agriculture and forestry as well. The investment, as you said, the investment needs are there. There's a gap, but also the investment opportunities are there because these needs that you outlined there translate themselves in clear opportunities and trends, especially linked to the climate side. So I think it will come. It will take a bit of time. One of the things I always find in general in the climate communities, we are jumping very quickly to bond finance, maybe too quickly, and we see this, for example, also in the nature side. There's some very complex bond structures out there, which on a standalone basis, I think they're very admirable. They're really well structured, but they're not scalable in a way. They solve a very specific problem, often with blended finance, that when you really look at it, well, we can't really scale this. So I'm always trying to say, look, there are a lot of easy solutions to finance forestry and agriculture and parts of the blue economy, which are very scalable and which will then over time also really lend themselves for bond financing. And I think that would be always my plea. You know, we have to have a bit of patience to get there. And at the moment, it's probably much more of a time of real asset investment, building that stock of financiable products that then can be refinanced through bonds.
Yeah, that's always scary when we hear that we need more time, because actually we do not. Like we really need to scale it up quickly, and yes, the replicability is absolutely key in developing that market. So I'm turning to you, Jacopo. I mean, what can you do within the financial institutions to actually really help scale that up, scale that market up?
No, just connecting the dots maybe on the clarity. I think in the market, you always need to define a sort of priority list of what actually you want to prioritize. I think, as every policy or every, let's say, budget or balance sheet consideration, you cannot finance everything. So you need to kind of pick and choose which is sort of your list. This doesn't mean it has to be single for globally, sometimes it can be regional. Definitely the CBI taxonomy and work has been very instrumental. At the same time, there is a lot of work at the regional or local level, what actually want to do more pragmatically, looking at sort of, different consideration. I think, at the same time, it's very important to look at the environmental and social assessment. I think there is a lot of uncertainty as we see right now, so how to mitigate any sort of risk or reputational risk, not only from, let's say, any potential greenwashing or, let's say, any reputational risk, but also to show things work and, naturally the project has the merit. And this is also very important from an impact assessment or impact metric, because end of the day, from an investor side, you want to get, what do I get out of it, like in the sort of short term, mid term, or whatever. I think, from our side, we're really trying to, engage with different industry body to scale up. It's definitely, it needs to be more flexible, and I think linked to the point of the product, it has to be scalable. So we're trying to figure out what actually is the solution. And actually, when we do product development with our business unit, we try to think about the picture of how can we making sure the client can understand very well. So basically, we have a three sort of stakeholders. So internally, of course, our governance, but also the client needs to understand very clearly. But also this external stakeholder needs to make sure, or has to be assured, that we're doing the sort of very concise. And I think, taking a certain example from, as a EU taxonomy, I think there was a lot of rigidity and try to solve the problem for everyone. And I think it's very difficult in the nature. I think here is going to be more regional or country level, where actually you try to prioritize the investment. I mean, in UK, as I mentioned, foundation finance is a very good example of, we have a problem in the country, we're trying to tackle with practical solution. The client have been understanding it very clearly, so we actually have a lot of traction because of that one. And similar to what Martin was saying, the product itself is self-explanatory, and we can really replicate to the scale.
Thank you, Jacopo. And I think you also already answered part of the third question around the architecture of trust, but I mean, when we prepared that panel, you also talked about regulation.
Yeah.
What is your expectation regarding that? I mean, is it like core part of that architecture of trust
for
for
sure,
financial institutions?
Yeah, for sure. I mean, regulation is very key because, I mean, to be fair, the voluntary initiative are very good, but to really have like a regulatory framework will really help. I think the TCFD show, when you start to put like mandatory disclosure on company, you really have a sort of quality of data and you have more sophistication. I think the UK was a good example, putting the TCFD mandatory reporting, and you see now the quality of data itself. Definitely regulation is going to be very key to set the scene, but for two reasons. One, to actually start the ball rolling to say I want to have consistency, but also, as I mentioned before, give a sort of pathway what I need to do, because right now there's auto company or auto counterparty say I can do in multiple ways, but how do I report in a way that is kind of like sufficient? There's always the question, what is the minimis value out of the second way? So definitely regulation will be clear. Not only the regulation, but also the market standard itself. So having like framework market standard, that's what I say, as a bank ourselves, we try to do it as well, to anticipating what we see the market. But definitely we have a lot of collaboration and engagement with like policymaker regulators, exactly for the reason, because we want to tell them where we see the sort of conversation with our client or our risk based on our, as mentioned before, our assessment, but also to help say this is what you should do, because once you scale up disclosure and data and certainty, or let's say at a certain environment, that's where actually the investment really lock in a more scalable and sizable opportunity.
Yeah, thank you very much. I mean, I'm always a bit worried about regulation. I mean, for all of you in the room, regulation is going to come for sure. and it's going to impose rules of the game that you would have liked to influence before. So that means that if you want the regulation to actually fit and meet your own development, your own market, you need to start playing in the nature investing field now. So that's an imperative again. Sorry for that. Chris, so Jacopo has framed the balance between clarity and usability. From the investor side, what information genuinely changes an investment decision and what simply creates noise?
Yeah, there's a lot of noise. Look, I think yes, I obviously agree with that regulation is coming. It is necessary, but it doesn't force people to care about it. I think that's part of the issue. So you can disclose all you like, but how do you go from disclosing data to capital actually flowing? And I'm not sure that bridge is automatic. Would be my first point. I think from the perspective of what data do we need to see, when it's obviously we need to understand nature dependencies, nature impacts. We need to understand the geographic nature of those impacts. I think nature is obviously fundamentally local, and I think that comes back to Martin's point about some of these amazing projects, farms or forests. They are fundamentally local, but therefore smaller in nature. But understanding that materiality, I think, is really quite important. I think you can get really bogged down in the amount and diversity of data that can be provided. So what we try and focus on is data that is decision useful and sometimes can be a proxy for biodiversity loss, for example. So that might be changes in land use, it might be pollution incidents, it could be resource use, so on and so forth. So that helps us to get a smaller list of useful metrics. And I think there is probably a little bit of an obsession with finding that sort of golden metric in the same way that we have with climate finance. It's not going to happen, but at least getting a smaller subset of metrics that we can focus on that will be useful for our clients. I'm not saying we're there, by the way, but we're certainly trying to get there. Is where we're trying to get to.
Yeah, thank you, Chris. And I think that's a very good question also for you, Martin, because on the real asset side, what does that mean? I mean, yes, it's complex. Well, it's difficult to measure, but still, you're doing it. So what's your architecture of trust?
Yeah, so I mean, the way we look at it, so we basically on the one hand side, of course, focus on returns, but on the other side, we also develop an impact framework where we're looking through the various indicators of biodiversity, climate, and social and water are usually the four kind of indicators that we're measuring, and then we have subcategories, and then for each investment opportunity in our investment committee, we actually have to demonstrate that we are achieving substantial improvements on at least a minimum number of these impact factors, and that we're not having any negative impact on the others. And I think that's a good way for us on a portfolio basis to measure that we have an improvement over time. And I think the industry as such is, I think, is I would say more or less working in a similar way. I think the challenge at the moment is, and that goes back to the whole discussions on TNFDs, that we are missing very clearly identified benchmarks or indicators that we all can agree on. And I think that's probably one of the things that's lacking. And I'm sure we'll discuss it. One of the reasons, obviously, also the limitations to get always all the data, in particular in an aggregated manner. But I think it is doable, and we're seeing also now that with increasing use of technology, it's becoming also a lot easier to capture that data.
Thank you so much. I mean, keeping on the aim of that panel, I mean, we've mentioned the instrumental role of the Climate Bonds Initiative in setting up a framework. We've mentioned the TNFD as also coming up with an instrumental framework for companies to report. What are the key coalitions or standards that are useful to each of you to actually develop the market for that the audience actually identify helps that can help them move into that agenda? Maybe starting with you.
Yeah, so I think there are, I mean, we're following kind of the usual approach you would do in sustainable finance, and you go to very similar frameworks that you do in climate. I think the one difference is really the TNFD, so the LEAP framework. So that's actually something that we're an early adopter and that we're applying, and we think that's actually quite useful starting point. It's obviously not solving all the issues, but it really allows us to kind of get into the right direction. So I think that's the one that is specific focus on nature.
Maybe Jacopo?
Yeah, no, from my side is actually the standard are very good, but also if I take transition finance as a good comparable, engagement and discussion are very important, especially among financial institutions. As I mentioned before, the different financial institutions, they really sit in the sort of deployment of capital or, priority. So definitely, as we are saying right now, we are discussing in different, let's say, how to scale up the traditional finance market. Also from a nature side, really talking, because eventually, you don't want to have someone to go, but tend to don't move. I think from our engagement with different, regulator or policymaker, they always try to have a sort of market push factor, which means different stakeholders, they try to jump in. So definitely what we're trying to do is talking. Actually, there is some financial institutions that reach out to us on nature and traditional finance as well to talk about how they can do more or replicating. So definitely there is momentum. I see now, if you ask me in the last 12 months, definitely more interest from different actors. However, as Martin was alluding before, you need to get the clarity because the framework is a good starting point, but at the same time, you need to sort of figure out what we need to work on, more pragmatically. So that's why I think the engagement will help to define at least a common ground where the discussion should really progress and try to, leverage in the coming years.
And Chris?
Well, I agree with the previous two comments. From my side, on the blue side, obviously, I'm in the bond space, so the blue bond standards critical. I think the work done by climate bonds, likewise, has long been viewed as a gold standard. EU green bond standards also helpful. Those sort of external validations, I think are really useful for us, when you're dealing with a retail client base primarily, not exclusively, but in simplifying that conversation. Right? So we meet a minimum set of standards, and I think our clients understand that.
Thank you very much. I think we have time for a couple of questions. Before having them, if someone can come with a mic. I'm listening to you. When we talk about nature, everybody is saying it's complex, it's local, it's super difficult to actually invest in. So I'm thinking that no, listening to you, it's crackable. You've all cracked the issue, kind of.
Yeah.
Okay.
I think so.
Yeah, I think one of the key things is, and I think when you think about how the whole discussion around climate came about, that was the same. Is at the moment we are still in a process where I think a lot of your institution or even your institution actually finance natures, but they won't really label it at the moment. And that's why it's the same thing when the first green bonds were issued, right? The segment was so small, it had to be so pure in a way, and everybody had to agree on that. And if you look now how long this industry has come here in regard to green bonds, and I think the same applies in nature. I think the more you kind of start looking to your portfolio, also starting from early stage financing to private equity financing to real assets, but also then to bond finance, there is a lot more nature in probably every investor's portfolio, but we're not labeling at the moment, and that's probably one of the key things that's holding it back, because there's at the same time, I mean, what I'm hearing from Chris is that there is a demand for very clearly labeled bonds. So I think that's probably one of the segments where a lot more work has to be done. And I think yes, some data is missing, but not all data is missing. And yes, a lot of it is smaller scale, especially when we start with the blue economy. But when you look about agriculture and forestry, you have some very, very large investment opportunities, some very, very large companies that are issuing bonds that are moving to more sustainability. So I think the key is to really now categorize this and have the same approach from a bond perspective than what you had on the climate bond perspective, and then I think there's a good opportunity to get there.
It's a very good point. I think Alejandro here has a... Sorry, go ahead, and then the mic moves. Please.
Yeah, thank you very much. Thank you for sharing your insights. I'm Aaron Kelshika. Just a question, because multilateral development banks, development finance institutions have categorically come out and been very visible about mobilizing private sector capital. So with this sort of model which they're moving towards, originate to distribute, how do you see opportunities with that with respect to sort of driving increased flows towards nature? And how are you actually engaging and interacting with them?
I can start there. So yeah, I think a lot of these sort of blended finance opportunities, I think are potentially very interesting. I think some of the sort of more traditional development bank labelled issues for us are not that exciting, because they usually come with a AAA rating, not very much yield, and going back to my original comments, that does not address the first criteria of why many of our clients invest with us, is to get an attractive level of income and attractive return. So the opportunities that we're looking for, we want to take a bit more credit risk. I'd say it has to be in a sort of more liquid format. I don't like some of the sort of highly convoluted structures, such as the outcome bonds. That creates a lot of issues for us. I think the development banks, I think they should be a key source, as you say, an originator of these opportunities, a pooler of these opportunities. I just hope that they can do it in a format that mobilizes the bulk of the capital market, the bond market. In other words, investors who are looking for a slightly higher yield than you can get on AAAs. I hope that answers your question.
Yeah,
Thank you very much. Maybe we'll take another question here.
Hello, yes. But thank you very much. Thank you, Maureen, and the panel. Great discussion. Alejandro Litovsky, I'm the CEO of Earth Security. We are tracking how planetary risks are repricing different asset classes and where the premiums on resilience are starting to show from a pricing perspective. And so two quick questions, very practical. One of the areas that we've looked at given this sort of resilience premium focus, has been blue, and coastal natural assets in particular. And so we found the question that the pipeline doesn't exist is not true, right? So we've aggregated 50 projects that are looking for around $500 million. These are nature-based solutions on a coastal level. They want to develop carbon. They're also providing incredible resilience benefits. And we've shown that the pricing for those carbon credits that carry resilience characteristics is actually higher, up to 20% than traditional nature credits. Now, the problem that we find is that out of that $500 million of potential, 10% of that is catalytic finance that is needed for the projects to eventually graduate and unlock the investable piece. And it seems to me that a bond could be a really interesting way of looking at it from almost like a multi-project bond perspective. And we're still trying to work out, and the question therefore to the panel is, given dozens of projects that are out there looking for funding, how do you, and the pipeline not being the problem, but really the capital structuring of the capital stack to unlock that, how do you think about structuring that, and what is the role that bonds can play? And if anyone wants to develop that sort of bond, please talk to us. We'd like to talk to you about that. The second quick question is, the work that we've done over the last 10 years, and Maureen funded some of that when she was at HSBC, I would say we have found that we are underpricing ecosystem services, right? I think the panel has mostly talked about nature as from a direct investment perspective, as alternative assets, and so on and so forth. But the much bigger opportunity is when you start to realize that nature is providing resilience value to every industry. Like we'll talk about energy, I think, later. A work showed that out of 1,000 hydropower dams in the tropics, 60% of those are benefiting. More than 50% of the water that they use in the reservoirs is coming from upland forests. And so how do we, question therefore, how do we bring that bigger perspective to finance those ecosystem services as part of the mainstream asset classes that we're financing? And I think here, CBI sort of launched this resilience taxonomy, really interesting, potentially could be applicable to hydropower, to a range of other water-intensive assets. But how do you therefore bring the value of nature into that sort of pipeline of opportunities that is not just, the agriculture, the forest, and so on and so forth? So anyway, two practical things, but thanks a lot for this. It's great to hear that.
Thank you for your short question.
Yeah, exactly. I was going to say.
Difficult to summarize.
Yeah. Do you want me to do it?
Yes.
Thanks for raising it, because I think that's obviously a big part of our thinking as well. And I think when you move from nature financing to natural capital financing, then your question kind of fits into that, right? And I think the question here is, and that's why I'm always very cautious when I talk to bond investors to actually mention this. But the question is, there's an economic value in nature, and it's undisputable. There's so many studies, the economic contribution that pollination and so on provides for our economy, but we're not valuing it in a financial way, and that's the fundamental crux. And partially it's because we just don't have the data, and partially it's also because we're just not used to it, right? We're kind of treating nature as priceless in a way, right? As free in a way. So and I think that's how you convert the economic value of nature into a financial value. That is where we have to get to, and that's, I think, the long-term vision, or what I believe in nature finance. I think we're taking baby steps there, that we are starting off in particular now, as you mentioned, carbon. I think that's probably the one element that is now better understand and can actually provide additional revenue streams for investors, also for more conservative investors. So, for example, we have one project in New Zealand that is benefiting from the New Zealand emissions trading scheme. So instead of having yield from selling woods, we're actually getting yield from selling carbon credits. And we do the same on a voluntary basis with one of our projects in the United States. So that is there. But I think when we think about biodiversity and biodiversity improvements, while we measure this now at the moment, it's very difficult to actually bring this into a financial context. And that makes it extremely difficult to finance. I think this is where I think the question on regulation will play a role, a question of more voluntary demand from some corporates in there. And I think it will come over time with more clarity what the value is. So, for example, one of the things we do tomorrow, we're part of the International Sustainable Forestry Coalition. They're working with the Capitals Coalition on exactly one project. We're a group of forestry asset manager, and we are trying to find a way now to value the basically the benefits of like putting a value on the benefits of investing in the biodiversity aspects of a project, of a forestry project. So there's a lot of work being done, but I think going now today to an I would assume to one of your investors, Chris, and say you should actually put this into your capital stock. They would be very, very, very. What we see in our the way we discuss it with investors, they see this as an upside. So if we're saying you can invest in a agriculture fund that is very traditionally managed, uses a lot of pesticides, and actually your cost with more pesticides go up over time, or here's a sustainably one which actually works because we are also having the sustainable business model also creates a higher yield. But on top of that, I have all these things I'm measuring, and I may or may not be in the future to monetize this or to put this in the revenue stack. That's really attractive to some investors. There is an environmental call option at the moment that investors are kind of, it doesn't change, it doesn't make it per se investable, and I think that's one of the crooks, especially with some of the smaller projects. I don't know exactly what you mentioned, but some of the projects I would have in mind what you just said. If you just have a project that is relying on these ecosystem payment for ecosystem services, it's really hard at the moment. And I think the one thing I would warn, and I think you kind of said it, Chris, with the output bonds are not as preferred by investors. It's like using bond finance for these type of structures. I find that you need a lot of blended finance in order to make this work, and then you have a very bespoke product. And for me, a bond should be something that is, that is simple and can be replicated and can be issued in scale. So I'm not 100% sure that bond finance for these, there are opportunities to finance them, but I wouldn't go and use bond finance as the first instrument to do that.
So we're over time. Just Chris, please.
Sorry.
I would love to see a coastal resilience pooled structure. Don't necessarily have an immediate answer on who that first loss piece would be provided by, but I'm sure there's a lot of smart bankers who do. So happy to have a conversation afterwards.
So thank you very much. We haven't had the time to really talk about the role of public finance versus private finance and how it helps scale-ups and how it's completely different. We haven't had the time to talk about really a little bit about carbon market and biodiversity market and how they can actually bring revenue stream to scale up that market. So there's still a lot of conversation to have to really scale up nature, but really thank you so much for the panelists for your insights, and I hope that everyone is really going to move into that market now.
Thank you so much. And note, investors, banks, small investors, large investors, there's a lot happening in this space. There have been sovereigns. One thing that Chris didn't talk about is that the Australian bond I mentioned earlier, 15% of the allocation of that bond is to nature protection, Great Barrier Reef. You're going to see a lot more of these mixed portfolios coming through in the sovereign space. In blue, the Netherlands' inaugural green sovereign bond was for coastal protection and flood management. It was a blue bond. So we've got this sort of stuff happening now. What we're now seeing is just the visibility of some of that investment, and for some people, special mandates. There are a couple of blue bond mandates out there already. So while I think Martin's right about the practical application of climate finance, I think at a sovereign and subnational level, we'll see quite a lot happening. And of course, Indonesia has issued a blue sukuk at the moment, which is a sovereign bond in an Islamic finance format already. It's a developing space. That's why we need these events to be able to talk through some of these ideas. That'll be lunch break, everyone. Work it out. In the meantime, I want to invite Nick Robins to the stage, who is going to be leading our next session on resilience. Nick is at World Resources Institute at the moment. He has a long and colourful history, HSBC and various other parties, but at the moment he's a collaborator for us on climate finance and a close friend. He's actually got a title of Senior Director of Finance at WRI. Nick, if I could get you to come to the stage and introduce the other panellists in your session. I hope Nick is here. Still getting wired up. Okay, well that didn't work. Okay, Nick, come to the stage. The security agenda It's got many aspects to it. It's energy security in Europe and Japan and China means clean energy, folks, nowadays, but there are other dimensions as well. This is what you're going to hear about now. Over to you, Nick.
Right, okay. Can you hear me? Very good. Okay, well, can the panel come up? Because we are over time, and we've got to fit a war in before lunch. So I'm really glad you stayed for this session, because this session is very nicely titled. It's called Financing Energy Security and Capturing the Opportunities in the Global Race from Fossil Fuel Dependence. And as Sean has said, my name is Nick Robbins, and working at the World Resource Institute, co-founder of the Carbon Tracker Initiative. And I've worked on the buy side, I've worked on the sell side, worked on the system side, worked on the people side on just transition, and now we're going to work on the security side. So to do that, I'm going to be joined by 4 fantastic people. To my immediate left, Lily Berg from the Home Team, who's the climate policy lead, global policy lead for the Climate Bonds Initiative. We then have Tom Dillon, who is the head of ESG fixed income at Aviva. Welcome, Tom. Anita McBain, who led sell-side research at Citi for 6 years and is currently a member of the King's College Endowment Investment Fund. And then Dan Marks, who is the Fellow for Energy Security, so you'll do the right job for this panel, at RUSI. So I'd just like to make a couple of sort of introductory comments about this. I think this year has really shown that, for us, fossil fuels could be seen as a poly problem with poly solutions. We have the second fossil fuel shock triggered by warfare in 5 years. This one triggered, obviously, in the Gulf. We've seen a difference in, I think, response. The impacts on the global economy have been severe, but not necessarily as severe as before. But I think what we're seeing is that this second shock, allied to the climate crisis, is potentially going to be enough to jolt the global economy out of its current fossil fuel high carbon rut. So we're about to bounce out of that. We know that the solutions to fossil fuel dependence are cleaner and cheaper and faster. We've seen countries who are well positioned, like China, Spain, Pakistan was mentioned earlier, are doing better than others. We're also seeing a new dimension, particularly coming from the central bank community. Central banks, such as the European Central Bank, are recognizing that fossil fuel dependence is a serious threat to price stability, which is the major goal of central banks. So very different framing now. Fossil fuels are no longer just an issue for climate risk, but a fundamental threat to price and also financial stability. And we have the issues of fossilflation rising through our economy. We are seeing reactions across the world, very different, and I hope from the panel we're going to see that, how countries are reacting to this. Some are going back short-term to fossil fuels, some are speeding to clean energy, so it'd be good to see some granularity on this. And clearly we're seeing real harm to people's livelihoods, to the cost of living of billions of people around the world, and that's something we should be taking in mind. So that's the sort of context, and we'll hear more from our expert panelists. So I just wanted to highlight, I suppose, the first sort of intergovernmental response to this, because at the moment some of our international organizations are not really working. The G20 is not really functioning as it should this year, and the UN is as well, sadly. But we had the meeting in Santa Marta, the Transitioning Away from Fossil Fuels meeting, hosted by Colombia and the Netherlands. And that was really the first intergovernmental response to this crisis, both to the climate crisis, but also to the question of fossil fuel dependence. 57 countries came together to really be a front runner, a leadership group to move away from that. And at that meeting, I was very pleased to co-chair the central bank work stream with a Chinese scholar, Isabel Jiani Zheng. And I think what is coming out of that is that this is the moment for leadership. We have countries in that group and others who really want to move fast for the benefit of their countries towards clean energy, away from fossil fuels, for climate reasons, but for security reasons, for competitiveness reasons as well. And this room, this panel, before lunch, is the opportunity to really think about how we see leadership really in the financial markets to back that policy leadership. So with that, I'm going to turn to you, Lily, really, for an opening comments, really about what you see the reactions, and particularly your community, your networks, the people who are issuing, the people who are buying bonds, the policymakers you talk to. How are you seeing the synergies between, I suppose, the long-term climate agenda, but also this question of fossil fuel dependence, and where are the tensions and the threats?
Thank you, Nick. I think it's really interesting because we're at a sort of risk point, and I think we can't be complacent that, from our point of view, the logical step is towards a clean energy transition away from fossil fuels. But, in certain jurisdictions, we are seeing, a ramp up in coal, we're seeing a ramp up in fossil fuels and sort of doubling down on fossil fuels despite the risks. But I do think we are learning lessons. So, this is not the first of the energy crises. It's not going to be the last. And I think the EU is a good example where we're slightly seeing a lesson learned that following the Russian invasion of Ukraine, REPowerEU did see a ramp up of renewables, but it also effectively switched dependence from EU gas to US gas. And since then, we have seen the risks of being dependent on US gas. So I think with the Accelerate EU plan, we are seeing an understanding that all fossil fuel imports are a risk. And our recent paper, we calculated 40% of EU fossil fuel imports come from countries that have threatened to cut them off. It's a huge, huge risk. And so I think Accelerate EU is focusing also on the enabling action, and that's crucial. So enabling electrification, 89% of EU end use can be electrified. It's huge. Grids, permitting, accelerating the grids package, that's crucial to actually enabling the transition to renewables. We don't need to worry about the build-out of renewable generation. It's that side. And I think we're seeing, on the other side of the world, Japan is also exemplifying that with the emphasis on grid investment. I think by 2040, we need 10 trillion yen, which is about 47 billion pounds, invested into the grid in Japan. And that development of particularly the sort of inter-regional connection, that sort of policy is going to be crucial. And I think those sorts of policy signals are then also giving investors confidence in the opportunities, but we need more. And I think, we've been talking to investors, we've been talking to developers, that policy certainty on simple things like permitting for grids is going to be vital to enable investment to flow.
Great. So learning lessons. Tom, to you, because you're in the capital markets, you're looking at fixed income portfolios. How is this crisis being seen, and where are the risks and the opportunities, the panel about opportunities that you see?
Yeah, thanks, Nick. So I work in the asset management arm of Aviva, focused on fixed income. So my team, as you mentioned, conduct our sustainable investment research, integrate that into the investment process, and we also conduct some engagement where it's fixed income related. And the way we think about this energy shock is through a lens of dependency. And the extent of that dependency or resilience to it determines the economic and financial implications. So for those economies that are reliant on imported fossil fuels, they are exposed to the physical supply of those fuels, shipping lanes, for example, and global price setting in those fuels. And we've seen those two as kind of major transmission vectors of global geopolitical volatility over the last year, but also the last 5 years, going back much further than that too. And so that transmits to growth, inflation, fiscal dynamics, spreads, returns, yields, these things that we care about as fixed income investors. So our research question is, how exposed is a given fixed income issuer? Can they absorb that shock? Can they substitute the energy supply that they're reliant on? And the determinants of that are lots of the things Lily just mentioned, so degree of electrification, domestic capabilities, be that nuclear, renewable, geothermal, grid capacity, grid flexibility, energy pricing mechanisms. Those are all the factors that are absolutely central to our bottom-up, our issuer-by-issuer research that my team conduct, and that helps us differentiate between different issuers of bonds and different investment opportunities. So no two energy transitions or pathways are the same. Each sovereign has its own energy system, and corporates play a different role in those systems. And I think that kind of validates our research approach because we've seen that economies that have invested in low-carbon, domestically anchored systems have been much more resilient to this latest fossil fuel-related shock. European countries that have less than 5% of their energy mix coming from fossil fuels saw power prices roughly half those compared to other European countries that had more than 40% of their energy mix coming from imported fossil fuels. So energy security and clean energy are aligned in this case because lots of the low carbon solutions are the most cost-effective way of reducing that dependence and therefore reducing that macro and credit market volatility. And I guess just a final thought, stepping back, is that's quite significant for me because it represents a change of the energy or climate transition from being a kind of values-driven, emission-based objective to something that's much more of a strategic priority with very tangible economic benefits. And I think that's quite significant.
Yeah, and I think that's a really interesting point, isn't it? Because so many in the room will either be issuing or analysing transition plans from countries or from companies. And this provides a sort of much stronger bite, I think, materiality bites, than some of those long-term targets, which are very important, but don't have those near-term drivers, I think. So that's really, really interesting. So Anita, to you, your thoughts, I mean, immediate reactions, the things you're seeing in terms of this crisis compared with others you've seen.
Thank you, and it's a pleasure to be here. Thanks very much, Sean, for inviting me. This is sustainability in a contested age. We are underprepared, we're underinsured, we're under attack. So understanding the vulnerabilities, the choke points in our system, they put us at risk. This energy shock that we're seeing today is actually going to accelerate the transition. And I've been listening to all the conversations today. The language that we're hearing coming up again and again is security, resilience, and defence. How secure is our energy system? How resilient is the infrastructure that underpins our food, energy, water system? And how have we actually invested in the defence of these assets that are critical to our sovereignty? So, to echo some of the points that have already been made on this panel, what we're now seeing is those countries that are actively investing in their sovereignty of their food system, of their energy system, of their water system, are actually investing in deterrence. It's reducing that vulnerability. So I think it's very interesting today to look at this confluence of all of these topics. I don't see these as single issues. If we have not built this resilience into our system, then we are vulnerable to a future hostile state or actor, or even a domestic actor, quite frankly. The 2022 crisis for Europe was about gas. Today's crisis is about Asia and oil. The head of the IEA called this the greatest global energy security challenge in history. So that word security again. So I think my perspective today is this is a contested age. Everything has been weaponized. Our food system's weaponized. Our water system is at risk. We've heard about threats to desalination. And our energy system has been weaponized. So I'm very, very curious now as to how we're thinking about the future to raise capital to invest in this defense. And I like this language around resilience. I like this language around resilience bonds. I'm interested to hear about, we heard that presentation earlier from Australia. How are sovereigns thinking about this? How are they deploying capital to build that resilience into their energy system? So I think all of these topics today are very, very live, and they have been exacerbated by conflict.
So you heard it here first, I think. Clean energy investments are a form of deterrence. I think that was very interesting. I think that's what you were saying. We're not going to be discussing the hot war that is going on or is going on, but I was talking earlier to Sean just to how there is an interesting sort of connection between the electrification trend that's going on in civilian markets in terms of clean electrification and what's happening in military defense and the move away from fossil fuel powered, very vulnerable assets through to much more nimble electrically powered drones, and we're seeing that in the major conflicts that are happening. We're not going to be discussing that, I think. Dan, you're looking at this every day. Your reflections on this, and maybe some of the things that people maybe thinking maybe a bit too glib about this, some of the things we might be missing, and some of the sort of discontinuities that you see in the energy security arena now?
Sure. Yeah, thanks for inviting me to speak. It's a big area, quite a lot of different ways we could go. I mean, I think the interesting, perhaps the starting point really is that clearly these crises, and it's not just the two major wars, so the 2022 full-scale invasion of Ukraine and the current war in Iran, but also alongside that a kind of constant drip of other smaller scale disasters. So the closure of the Red Sea, disruption to the Panama Canal, the accident in the Suez Canal, all of these kind of issues which are coming up, and they're coming up more regularly, climate will make it worse, are kind of just chipping away at supply chain resilience writ large, and oil and gas in particular, because the two central major kind of geopolitical events are happening in the biggest oil and gas producing regions. So you have that kind of inbuilt rigidity, and then you're kind of factoring other things on top, and that results in price volatility, things like that. But I think it's also important to say that this makes it harder, the solution harder as well. Right. So security comes with both kind of the motivation that we want to reduce the use of oil and gas, but also the requirement that you secure the energy grid. Yep. And that's expensive at the end of the day. And there's also questions about what do repeated shocks mean from an energy security perspective for the tools that we currently have. So if you're going to have relatively regular disruptions to your fuel supply, stockpiles become less effective because you have to refill them. Storage potentially becomes less effective. So what does your oil and gas security look like as well? Yep. And that's also a kind of challenge alongside and can distract from other kind of issues. And then at the same time, you have the question of 2025 saw rare earths weaponized incredibly effectively, right. In a very asymmetric way. It's a tiny market, like less than one LNG project, and yet it probably was the defining factor in the US-China trade war, or certainly one of the major factors. So I think you have that, and then on the other hand, you have the fact that these crises themselves, by dint of being war on Europe's borders, create more uncertainty for the energy sector. So what does resilience in offshore energy mean? And this kind of leaves governments having to basically come from quite a low base in terms of categorizing, well, what are the right policy responses? How do we think about them? I think they need to. We're at that point. We're at the very earliest point of how do we actually just categorize these risks. I think you need to do it by policy bucket. So what is a technical specification question? What is a performance standard question? What's a voluntary question? And then are these industry led? Are they public led? If they're public led, who does it? Because there is no public agency for resilience, there's no public agency for offshore security in a lot of places, and who funds it? So is there going to be like a government fund, or is it just going to go onto consumer bills? Because energy price is also a strategic issue, it's a defense issue, it's a European strategic resilience, strategic industrial base kind of issue, so you can't just layer costs on top. So I think governments need to get their own houses in order. There's also the question in these security arguments of private asset operators need a public counterparty. So if you're in a crisis, if you want to report, say, loitering drones, suspicious activity, who do you report to? And then when do they escalate it? And who do they escalate it to? And what do they do when it's been escalated? And who are you going to be engaging with throughout this kind of process? What's done with that information? That requires an investment of time for governments and kind of momentum, and it also a cost because you have to have you staff these agencies and things like that. So I think ultimately, it comes down to a question of, do governments really, especially when it comes to investing in resilience, do they really think that hybrid warfare and an attack from Russia are actual threats? If they do, then they need to put the money there. I think the age of saying that there's a threat from Russia and hybrid warfare is all really serious, but then in kind of stage whispering to the kind of industry, but we don't really, it's not really our priority. We're not going to put any money into it. I think that's kind of, it's ended. Like, it's not useful for industry. They don't know what to invest in. It's not useful for the public. They don't believe the politicians. And, you can see that in the UK because it's a major factor behind the end of Keir Starmer. So, yeah.
I think that's the first time it was mentioned today. Very good. Very good. So we're all in a even more disorderly world, and I think any of us who have maybe grew up in the age of globalization, that age is gone, and we're an age without regime. We have no regime. The global systems aren't working here. And clearly, we need investment. And I think certainly in European countries, but many other countries, the fiscal space for more income tax related is limited. Headroom on debt is limited in many countries as well. So we have some real challenges. I'm going to turn to you in the audience to layer in a few questions. And please, questions, short, sharp questions. Thank you. So who wants to start? Please, and say your name. Thank you.
My name is Kai.
No, wait for a microphone. Wait for a microphone. Thank you. And a quick, short question. We'll try and take 3 or 4, and then we'll come back to the panel.
Well, my name is Kai Emren, working with the newsletter called Methane Breathe.
Yep.
I would like to ask you, why don't we talk about coal mines and the methane? This is one of the most sort of low-hanging fruit.
As an energy security issue.
Yeah, well, it is when you look at the development also in India, the data center development, the pressure of the war. So the coal mines, they have technology solutions. Well,
okay.
But
Thank
no
you. Thank you. We're going to go to the next question, please. Okay. The one man with the hand up there. Thank you.
Hi there, Nav Runia, Portfolio Non-Exec Director doing sustainable finance.
Thanks.
How do we look at the politicization because of the pass-through of greenflation? We talk so much about greenflation and modeling that in macroeconomic models. We talk about climate risk stress testing, that all these financial institutions have to do, and financing energy security is not going to happen if greenflation and the consumer and politicians revolt.
Right. Very good question. So we have 3 categories of new types of inflation now. We have climateflation, the shocks that we're seeing from climate harm, loss and damage. We have fossilflation, which we're seeing because of the fossil shocks, and greenflation, which we're seeing in some instances. Actually, we're seeing green deflation in other areas as well. Third question, please. Please, here. Thank you.
One at the back.
Sorry, one at the back.
Hi, Lauren from Fairlight Partners. So we've spoken a lot about energy security in the context of defence. We've not spoken about it in the context of innovation. How do we feel about data centres and the impact on the grid and what that could do to energy security?
Brilliant. And do we have one more? I can't really see very well. Yeah, I think we have one more, so I honestly can't see. Yeah.
Hello, I'm Paul Camp. So there is a problem with language associated with energy security. So if any of you know Star Trek...
A question, please.
The question is, how do you overcome the language barrier between the grid technicians and the finance community? Because when grid talks about capacity on the grid, there's actually sometimes no problem with capacity, but it's a part of the grid is used at a certain part of the day, and you only need a small amount of capital to put battery energy storage on to smooth that capacity out. And so there's how do you get over that problem with the language associated with grid and capital?
Thank you. So back to the panel, back to energy security. Tom, you're in the markets. Thoughts to those questions? Also what you've heard from the other panelists about, and particularly sort of thinking through how we respond to some of these things.
Sure. A range of questions there. Perhaps I'll go for the inflation one because as fixed income investors, we don't really like inflation. So 3 new types of it is something complex for us to navigate. And I guess to me, that just kind of, again, validates the value of having a sustainable investment research function where you can have people who have dedicated expertise in understanding some of those trends that are going to be driving new forms or at least new labels attached to inflation and connecting that to the investment process to make sure that our investments in gilts or corporate bonds fully understand these new and emerging dynamics, and therefore we can take account of it when we're making decisions and when we're kind of through portfolio oversight as well. So I think there's different parts of the process where we can really kind of use our expertise in understanding those new forms of inflation and make sure that's reflected in our investment decision making.
If I could just add to that inflation issue, in the work that we did at Santa Marta, we had central bankers acting and people being past central banks, including Dr. Ma Jun from previously at People's Bank of China. And I mean, he touched on a very major point about the inflation issue, because that's the core to the central banks, and often the response to rising prices and inflation is rising interest rates, which, as we know, for often a capital-intensive transition, could curb some of the things we're trying to invest in. So, as many of you will know, in China there is a green refinancing facility where project developers and others can get refinancing at 1.5%, which has just been reduced to 1.25%. And there's quite a live debate here in Europe about whether we should have bifurcated interest rates, essentially one which is transition and sort of resilience and security line, and one which is more for the general economy. And I'd just be interested in the panel, as an investor, whether you think, particularly Tom, maybe you as an investor, maybe on the policy side, Lily, whether you think that would be a sensible way to go, to have that sort of bifurcated interest rates to respond to these different types of shocks. Any thoughts?
Shall I go again? I think that's sensible because ultimately it helps address those dependencies that I started with. It helps provide cheaper capital or more secure capital, longer term capital to investments that can, at an economy-wide level, start to reduce those dependencies, which I said we as fixed income investors are monitoring closely and taking into account. Yeah. So I think, the outcome associated with that action could be positive.
Okay.
We would reflect that positively.
And Anita, with your sort of analytical mind, what do you see about this idea of having two types of interest rates, one which is more transitional line and one which is more the rest of the economy?
Yeah, I mean, it's very interesting. I'm not sure if we need to be introducing more complexity. Right. The conversations that I tend to have with investors and with corporates is that we've spent the last 10, 15 years trying to navigate and find our way through various different data points. I think we've got more than enough data. It's not really, we don't need to create any more hurdles really for investors now to invest in these investment opportunities.
Okay. And any thoughts on the questions you have?
Yeah, just a really quick one on the methane. If I think I understood it correctly, I have looked at some of the solutions on methane. It has got 80 times more global warming potential than carbon dioxide. We know that the sources of methane are the flares from the oil and gas industry. We know it comes from the livestock, from cows, and we also know that it comes from waste. And there certainly are some solutions that are developing with, for example, the methane SAT technology that's coming out of the Environmental Defence Fund, if I'm correct. So the ability, and once again, it does have this almost dual use into some of the work that we're seeing with satellites that comes out of some of the defence primes, but we're starting to see the ability to map methane emissions is much more powerful and it can equip, for example, the oil and gas industry to understand exactly to which facility and to which pipe the emissions are coming from. So we are actually making progress on methane. Sorry?
Okay.
Coal mines, yeah. So we are, from the work that I've done on desk as an analyst, I've certainly seen there are some interesting solutions coming to market that investors like Tom can actually use for engagement with these types of facilities.
Okay, good. And to the questions, Lily, any thoughts? And then take you down, and then we'll start wrapping up.
Yes, I think staying on the methane topic, I would say the coal mine piece, and that's an example of where we possibly don't need to overcomplicate the role of policy in enforcing strict closure requirements, monitoring requirements. That piece is not, it doesn't, we don't need to necessarily look for it as a sort of, a new investment solution. It's that strong role of policy, and I think we're seeing some really interesting things out of China and making progress on the coal methane piece because, China is, coal methane is huge there. But I'd also say it's a really interesting one in the EU. The EU methane regulation is currently under attack by the US, and the US is threatening to cut off LNG for the methane regulation. this is an exact example of how climate policy can drive energy security. The methane regulation would allow countries to, would incentivize countries to stop importing from those methane-intensive suppliers, US being prime among them. These sorts of policies are the ones we really need to defend, and it's a question right now of the methane regulations. Now it's the member state level of the level of fines they implement. Obviously, the weakening of those fines will weaken the impact. So I think we need to look for these sort of policies and defend them with that energy security lens.
Yeah. Danny, your first round, you mentioned many things. You said, where's the money going to come from? And we talked about interest rates, which is making the cost of investment higher. Any thoughts on the questions?
I mean, on the questions and on the interest rate, I mean, on interest rate, I just always think that it's kind of underexploited in Europe a little bit, that renewables are a capital product in many sense, and it's part of your resilience, your security, and your cost it's your cost of finance. So the state could be leveraged more to do it, and it's a security benefit as well. On the questions, I'm going to kind of corrupt them in order to answer the questions that I want. But I was in an interesting conversation this morning at DTEC, so the Ukrainian energy company around coal, so less coal methane, but coal itself. And one of the asset managers there was saying that they are starting to have conversations about whether you could finance coal in some circumstances where there's a clear managed transition pathway. So they said they were starting to have those conversations with some of their LPs. Like some of them, largely, there's a large group that are just absolute no, and that's still the predominant view. So it's not just a government, it's a kind of private investor thing. But it's back on the cards for some, and they say obviously we need a lot of detail about how this works in transition planning, but you kind of have the question of, with gas out as a transition fuel obviously already a controversial term, but coal starts to come in as a potential, and once you start talking in security terms, that's kind of inevitable. So I think that's something that may come up more and more, and may need to be kind of addressed. On the data center front, it's interesting because I think you have a dual security requirement. We probably do need some data centers in Europe, in the UK. That's being shown as well by kind of recent actions on Anthropic, etc. They do require a lot of energy. They skew the system. We don't have a lot of energy. And I think it feeds actually more into the industrial question that actually industry is very highly constrained. And there is a question about can industry in Europe wait for the grid rollout? What could be done quicker? How could we use batteries better? In the Netherlands, DNOs can be using mobile batteries to kind of overcome distribute. So you bring a mobile battery in within a few months, you then don't have to wait 2-3 years for the distribution or transmission upgrade to happen, and you can do self-generation immediately. If we wanted to do things quickly, especially for industry, these kind of enabling things need to be thought out, and we need to be a little bit less rigid about, okay, DNOs, no chance they do batteries, it would affect the grid. Right. So we can monitor it, you can make sure they're not playing in the market, all of that kind of stuff, and do it purely for frequency control and as an enabler. I think we need to be thinking about stuff like that, and also the kind of Texas model of, well, bring your own power. So it's like, yeah, you want to build a data center, brilliant. Yep. Where's your power solution? Because the grids can't do it. You can't. It's a public resource.
Fascinating. This panel could go on forever, but we've got lunch, I believe. So we're going to have to wrap up. And I'd like us to look forward, and maybe your thoughts about what we need to see in terms of action from policymakers or investors or issuers in the room to actually deal with some of these very, very complex tensions, but also sort of move forward where we can and see some of the opportunities.
Yeah, thank you. And I think hopefully everyone's kind of gets my narrative here, which is we're looking at sustainability in this contested age, looking at it through a lens of security, resilience and defence. So from the issuer perspective, how does an issuer, whether it's a sovereign or a corporate, position itself as a solution provider to deliver that security or that resilience or that defence, whether it's to an industry, whether it's to subsea cables? I mean, perhaps just to be provocative, could a water fund invest in dual-use technology, in submersible drones,
to survey undersea infrastructure, which we now know is the new asymmetric hybrid warfare. So how do we now expand or widen the aperture to think about what is investable through this lens of security and resilience and defence? How do corporates and issuers think about that? And on the flip side, how do investors in companies that are on the front line of these sort of threats? We know a lot of cable, telecommunications. We've talked about the Baltics here on this panel, or even here today. All of these undersea cables. How do the companies that we invest in, if we've got investors in the room, actively engage with their portfolio companies to understand how resilient their supply chains are to these potential hybrid attacks? So that's my sort of takeaway, thinking about security, resilience and defence in a contested age. Thank you.
Certainly is contested. Thank you. Tom, from your perspective, as in the markets, what do you want to see in the next few months?
I think looking ahead, it's all about long-term solutions and long-term planning as opposed to short-term fixes. So thinking about sovereign responses, household energy subsidies might be necessary for other reasons, but they won't build resilience to the next shock. And investing in an aging grid, that will. Thinking about the next few months or the rest of this year, you mentioned water. We're forecast to have a strong El Nino at the end of this year. That will disrupt rainfall, and that could have quite a significant impact on energy systems that are anchored around hydro in South America, for example. Yeah. So there's different types of dependency, not all related to fossil fuels, but still linked to climate change. And so, we'll be working to understand that.
Yeah, very interesting. I mean, certainly, again, that makes the energy transition in Latin America very complicated. Yeah, not so simple. Lee, from a policy perspective, what are you looking for?
So I think this year we can see some of that policy certainty that investors need to enable investment into the transition. And I think, it's been speaking a lot to industry and investors, particularly in the sort of EU, there's this constant requirement for policy certainty. And it's simple things like I mentioned on permitting, but it's also possibly we need to revisit how we govern these pieces. So, in the Commission, DG ENER doesn't talk to the defence side. It doesn't look at that security side, and they see it as a gap. They see this, they know the grid has a security issue, but they're not able to sort of bring it in. And we're seeing this across the world that without that security angle, we're not going to have the rapid development of policy that will enable this sort of policy certainty for investment. And I think we're seeing this, and again in Japan, there is huge investment appetite for investing in, say, the grid, but we need the sort of regulatory clarity on the revenues that will enable repayment of these bonds. Mm-hmm. These are the sort of simple things that, without that policy certainty, we're not going to have investment flow.
Yeah. No, very good. And Dan, for you, we've got a number of summits coming up. There's a NATO summit, I believe, coming up. Do you see opportunities for getting sort of policy clarity in this arena, in this energy arena?
I think it depends which bit of the arena we're talking about. So I think there is definitely potential for clarity on the resilience side. And I think that's where governments could really need to move faster and think more carefully, because there is also a risk that the resilience requirements could fall more heavily on things like wind than on oil and gas offshore, for example. So how do you classify the different measures, move on that? What are the right kind of policy modes for the different types? What is your least cost, highest impact measure? How much are you willing to pay for it? How much are you going to put into it? And what is the point of it? That can be done relatively quickly in some sense. Needs a lot of consultation, and it needs some momentum, which it just doesn't have in the UK and has a little bit in Europe, but not enough. Right. I think where there is needed, but there isn't yet, is more clarity on security, energy security strategy writ large. So I think not another document or waffly strategy, but like actually just a position on what do we think about imported LNG? Like what do we think about oil product security going forward, jet fuel, diesel, refineries? How do we reduce demand while maintaining security and have a coherent strategy, that looks a little bit more like China's, and a little bit less like some 2010s 180-page document that says absolutely nothing at all.
Good. We're all in favour of short, punchy documents, aren't we? So I'd like to ask you to join me in thanking the panel, and it's now lunchtime, I believe. Thank you. Thank you, Lily. Thanks.
Did you know there's one refinery in Nigeria that supplies 20% of the UK's aviation fuel? That's insecurity, isn't it? Thank you so much for a great panel. Really interesting topic, a lot to be in this. Please, lunch, network, and we'll be back in less than an hour. Thank you, Anita. Thanks for the time. It's